Financial markets have felt more fragile recently, with investors concerned about the economy and the possibility that the Fed may be behind on cutting rates. The S&P 500 index experienced a dramatic 3-day decline of roughly 6%. Ironically, despite the recent market volatility, major indices have recovered and are back nearing all-time highs. While there is heightened market uncertainty, the S&P 500, Nasdaq, and Dow are still up 13, 12, and 6% with dividends this year. This is a reminder that while market swings are never pleasant, looking past short-term volatility is the best way for investors to stay focused on their goals. In addition to economic and fundamental factors, market technicals may have also worsened the recent pullback, with investors focused on the unwinding of the Japanese carry trade. Much has already been written on this topic in the financial news, but it is an important example of how technicals can impact markets in the short run, even as fundamentals drive returns in the long run. What is a carry trade, and why is it being blamed for the global stock market declines? While it may seem complex at first, the concept of a carry trade is actually quite easy to understand. A carry trade simply involves borrowing at lower interest rates and investing at higher rates, thereby earning the difference in yields. This also requires buying and selling currencies, since investors will often utilize government bonds around the world. In general, carry trades are more attractive when there is a large difference in interest rates and when currencies are stable. Borrowing using the Japanese yen for the carry trade has been popular for decades, since Japan's interest rates have been extremely low. Until recently, the Bank of Japan's policy rate had been negative since 2016 and had not been higher than 0.1% since 2008. In fact, the highest it has been this century is 0.5%. There were many reasons for low rates in Japan, including the risk of deflation, sluggish growth, and poor demographic trends. This period is sometimes referred to as Japan's lost decades. Things changed recently due to rising inflation and the Bank of Japan raising rates to 0.25%, all while the Fed is expected to cut rates. Not only does this decrease the interest rate differential between the US and Japan, but the Japanese yen has also strengthened over the past month and jumped overnight when market volatility hit. These market moves work against the typical carry trade, since the difference in rates shrinks and the borrowing currency becomes more expensive. Note that the way the yen is typically quoted, the number of Japanese yen per US dollar, a higher number represents a weaker yen. On its own, the reversal of one trade does not usually trigger widespread concern, especially on a global scale. However, since carry trades depend on borrowing, they can have an amplified effect. This concept, known as financial leverage, has worsened market crises throughout history, including the 2008 global financial crisis, the 1997 Asian currency crisis, and the collapse of long-term capital management, and even the crash of 1929. It's also important to keep in mind that shocks to different parts of the market are not unusual, and not every potential source of fragility results in this level of volatility. Many economic cycles experience periods of expansion and contraction without triggering a crisis on the order of 2008 or 2020. Last year's banking crisis is a recent example of a serious issue that eventually stabilized. So while vigilance is necessary, it's equally important for investors to maintain a balanced perspective, recognizing that markets have historically demonstrated the capacity to overcome challenges. Major stock market indices are still below their recent highs, and it's always possible that investor unease could continue. Still, history suggests that pullbacks and corrections are not only normal, but can also be healthy as markets adjust to new economic, market, and company data. This chart shows that the typical correction involves a decline of 14% on average, which then recovers within 4 months. The key, however, is that the recovery can begin when investors least expect it. So while day-to-day swings can be unsettling for investors, it's important to understand the longer-term trends. The unwinding of the carry trade may have resulted in shockwaves across global markets, but there are signs that the situation is stabilizing. Focusing on the business cycle, corporate earnings, and underlying market factors can help investors to see past near-term volatility. What's the bottom line? Markets have felt fragile due to both economic concerns and technical factors, such as the Japanese carry trade. Rather than worrying about short-term market swings, investors should focus on long-term trends in order to stay on track towards their financial goals.